the convergence of these factors would have seemed impossible to me. And generally, if I feel something is impossible, it's going to change.
Nobody has gotten by with the kind of money printing we're doing now for a very extended period without some trouble. And I think we're very near the edge of playing with fire.
So do you see systemic threats to the financial industry as great or greater than happened in 2008?
Yeah, this is bigger than what happened in 2008.
Hey guys, welcome to the channel. My name's Travis, and if you're new around here, I like talking about investing or anything to do with building wealth. If you want to hear more about topics like these, make sure to subscribe. It doesn't cost you anything, and if I say anything dumb, you can always unsub at the end. So the reason that I'm making this video today is because I know a lot of people are getting very uneasy about the stability of the market. Almost all economic indicators are saying that the market is very overvalued, that most likely we're going to have to increase interest rates, and that the value of the dollar might be in trouble. Even Michael Burry, the guy who became famous for predicting the 2008 financial crisis and betting against the banks, is predicting that there's going to be another crash. Because of everyone's uneasiness, I thought that I would make a video covering one of the stocks that I believe that would be great to buy during a market crash and even before a market crash. Actually, I think a market crash would cause this stock to go Super Saiyan.
This is a Super Saiyan.
This company that I'm talking about is Berkshire Hathaway. Now, before you guys laugh at me and call me a boomer, let me explain. Just in case you don't know what this company is, it's a conglomerate that the Warren Buffett owns. This company invests in both publicly traded and privately held companies, meaning it has access to companies you can't buy on the New York Stock Exchange. His portfolio is made up of 47 publicly traded companies and 70 privately held companies. If you want to know what's in his portfolio, make sure to check out this video. Okay, so why do I think this company is recession-proof? Well, there are a lot of reasons why I think that this would be a very good buy during and even before a downturn. Those reasons are what I want to talk about today. Well, to start, it being a conglomerate means that it has a lot more freedom to manage its own assets the way that it wants. For example, if you look at a mutual fund or any actively managed ETF, usually these funds are holding little to no cash. This is because there's always a ton of pressure from investors to have a mass majority of your funds actively invested at all times. For example, whenever you look at one of the hottest ETFs on the market, the ARK Innovation Fund, it has very little to no cash. As soon as they receive funds, the money is almost immediately invested. Well, that is not the case with Berkshire Hathaway. So my first point is, Berkshire Hathaway has $138 billion sitting in cash. Because of this, it's very clear to me that right now, Warren Buffett believes that the market is extremely overvalued. Him and his company aren't necessarily waiting for a crash, they're just waiting to find an investment that has good value. So if the company is holding on to a ton of cash, what that tells us is that most likely there are not many good deals out there. So as a result, the company is strapped to the roof with cash. Right now, this company is a financial fortress. This is the first reason why I think that it's going to be a great investment for an upcoming recession. One really quick point before I move on to the next idea. In general, I think it's a really bad idea for regular, everyday investors like you and I to hold on to cash. Warren Buffett is the exception. So if you want an explanation for that, make sure to check out this video. The second point is that because they're cash rich, they're going to be able to do what they do best, which is buy stocks on sale. They've done this throughout their history and especially during market downturns. For example, he bought Coca-Cola stock right after the Black Monday stock crash of 1987. Since then, he's made 1,750%, and this doesn't even include dividends. Buying during times like these are why he's managed to have a 2,744,000% return over the last 55 years versus the S&P's 20,000. The third point is, not only are they going to be able to buy new assets at great prices, this company has not just one, but two of the greatest investors that have ever lived. And of course, the second person that I'm talking about is Charlie Munger. Combine that with the possibility of a crash and having a ton of cash on hand, you've got a lot of potential to make a lot of money. Nowadays, everyone loves Cathie Wood, and I'm not saying that what she's done is anything short of phenomenal, but Charlie Munger and Warren Buffett have been beating the market for the last 55 years. They've seen practically everything that there is to see in the market. The fourth point is buybacks. Warren Buffett understands his company better than anyone else, meaning he also understands whenever his company is undervalued. So during the pandemic, whenever everyone was criticizing him for doing nothing, he was busy spending $25 billion buying back 5.2% of Berkshire's own stock. He knew it was undervalued and he took advantage of that. Meaning everyone that was holding on to Berkshire stock at the time now owns 5.2% more of the company. I know this is a little bit hard to understand, but if the company that you own now owns 5% more of its own assets, you now own 5% more of that company. I understand if that's a bit confusing, this is really hard to conceptualize, but all you need to know is that this makes you more money. This is basically the equivalent of getting a 5.2% dividend yield, but with no taxes. I fully expect them to do something like this again during a downturn. The fifth point is, because it's a conglomerate, it's diversified a little bit like an ETF. Yes, you can argue that because Apple stock has grown so fast that it makes up a huge portion of Berkshire's portfolio, but in general, this company is very diversified and holds businesses in many market sectors. Information technology, financials, consumer staples, it has businesses in so many industries. Railroads and insurance are a huge portion of its business, both of which are very steady during a downturn. And the craziest thing is, even if one of his businesses is in danger of going under during a market downturn, it'll just get a bailout from the Bank of Buffett. This is what he did with Bank of America in 2011 after the whole subprime mortgage situation in 2008. This resulted in a huge profit for Berkshire Hathaway. Buying Berkshire Hathaway is a little bit like buying an ETF that's managed by two of the greatest investors of all time with a 0% expense ratio. And one more thing before I move on, Berkshire shareholders tend to be a little bit more mature in the way that they invest. And by this, I mean they're a little bit less likely to panic sell. This is one of the many reasons why you don't see huge swings in the price of this stock. Okay, so the sixth and final point is a little bit more complicated. Part of the worry right now is that to prevent runaway inflation, the Fed will have to increase interest rates. Well, there have been plenty of studies on how certain stocks react to situations like that. Multiple of which have compared how value stocks and growth stocks have performed during situations like these. Well, this very interesting article talks about the conclusions of those studies. In this article, it says stocks are often broken down into subcategories, value and growth. Value stocks have strong current cash flows that will slow over time, while growth stocks have little or no cash flow today, but are expected to gradually increase over time. Therefore, in times of rising interest rates, growth stocks are negatively impacted far more than value stocks. So it's been shown during times of rising interest rates, which is what we're worried about, that value stocks perform better than growth stocks. And there is no doubt that this is a value stock. This is part of the reason why boomers like me own it. Okay, so these are some of the reasons why I believe that Berkshire Hathaway is a must-buy during and even before a market downturn. And let me clarify, by no means am I saying that Berkshire Hathaway stock won't go down during a downturn. What I am saying is that Berkshire Hathaway will take better advantage of a downturn than almost any company out there. Basically what I'm saying is this company will come out of a downturn so much stronger.
And this is what is known as a Super Saiyan that has ascended past a Super Saiyan.
Obviously, it would be ideal to buy this company during something like a market downturn, but I'm very confident that no matter when you buy this, it will come out stronger afterwards. So if you're looking for something to invest in now, I think that this company would be a very good option. So thank you guys for watching. Definitely subscribe to my channel. I'm still a very small YouTuber, so I'm not kidding when I say every subscription that I get seriously makes my day. And also, because I am a small YouTuber, I read all my comments. So if you have any questions for me, don't be afraid to ask them below. So thank you guys for watching, and I'll see you next time.